You watch metals and markets every week, yet still shop with the big guys? Why pay more for your precious metals from the guys who have offices on Wall Street and who bank with JP Morgan? From the basics like eagles, maples, rounds, and bars, to collector coins like Silver Shield and Heroes, SD War Collection, to our exclusive new line of insurance, approved, TL-rated precious metal safes, SD Bullion is what you're looking for at the lowest prices, period. Guaranteed! Because if you don't hold it, you don't own it. SD Bullion, founded by stackers to help you prepare for what's coming. Shop with the doc today at sdbullion.com.
This is the Doc and Eric Dubin with a special Precious Metals Roundtable edition of Metals and Markets. We have a star-studded lineup of precious metals experts for today's show. We have David Morgan of silverinvestor.com. Thanks for joining us, David.
My pleasure, thank you.
We also have GATA's Bill Muprhy. It's great to have you back with us as well, Bill.
Well, always good to be here.
And finally, last but not least, we have Alistair McLeod, Head of Research at Gold Money. Thanks for joining us from across the pond here this Friday evening, Alistair.
That's my pleasure.
Well, guys, it really is a distinct pleasure to have you all join us today for this discussion. So let's jump right into it. I'm going to try to stay in the background as much as possible today. I'm a bit under the weather, so why don't you guys take it from here?
So we've had some really great trading in the precious metals space in the last couple of months. Looks like we're in the process of moving a lot higher. In fact, today, in fact, throughout this whole week, we've had a really strong dollar vis-a-vis other currencies around the world, and despite that, and despite other turmoil in financial markets, precious metals have been doing pretty well. Thank you very much, and I'd love to throw it out to you folks as far as what you think is going on and where metals are going to be trading in 2015. Maybe Alistair, give us your take.
Well, absolutely. It is fascinating. There has been, I think, a turnaround in sentiment. Remember that 2014 was the year when Goldman Sachs came out and said that gold was a slam dunk sell. And what happened? Gold actually just moved sideways over the year. And as a result, in foreign currencies, not so much in the dollar where it was unchanged, but in foreign currencies, actually gold moved up over the year. And if you were in an unfortunate position of being a Russian, it doubled. I mean, mainly because the currency went down. And I think we do forget that measuring gold in dollars actually is not the experience of the majority of people in the world. And it does actually distort our view somewhat, because at times like the last 3 months, when the dollar has been exceptionally strong, and really exceptionally strong, it does distort the whole picture. So in that sense, I would say that gold has actually behaved reasonably well. I mean, obviously we would have liked it to have behaved better. But I think particularly the last 2 months has been very instructive, because all hell has broken out in other markets. Bond yields have collapsed. Equities have gone up and down like a yo-yo. And, there are huge worries. And most notably, the price of oil since the middle of last year has halved. And in December alone, I calculated it was down something like 25%. I mean, these are huge moves, and they've got huge implications behind them. And I think that gold, in the past, people would sort of say, well, oil price falling, if you price oil in gold, then that suggests that the price of gold should go down. Or alternatively, they would turn around and say, oil price is falling, it's deflation. Right, you want the dollar, you don't want gold. In other words, you get this sort of stock reaction. Dollar strong, gold weak. That is a fundamental change that we have seen over the last 2 months. And I think that's a very important point to note.
I'd like to add to what Alistair's saying, that gold has traded so differently the past 2 months with these volatile up moves. I call them air pockets, where it goes up out of nowhere and for no apparent reason, or even better when the dollar is very strong, like it was earlier this week as part of this fear trade. Hopefully it really is a transition into something spectacular, in which we're, from the GATA standpoint, where we come from, that the gold cartel is running out of enough physical gold and hopefully silver, leave that up to Dave, but where they hit the wall, the tipping point, and all of a sudden it explodes. And if I'm going to be right this year, when they finally hit this point, it's going to be something that we we really haven't seen in a very long time, where gold and silver just go bonkers, where they hit the wall and all these fundamentals that have meant nothing all year kick in and they can't stop it. So I agree that the increased volatility, in combination with what's going on in oil and how the Dow's going up and down, which often signifies trend changes when markets trade like this, and it's doing so violently, with great volatility. We could be into an exciting time when the mainstream gold world there's almost nobody very bullish. I mean, nobody. So it could be quite the surprise. That's what I'm hoping and expecting.
And Dave, I'd like to toss it over to you, but before I do that, let me just ask a quick question with Alistair, build on what Bill just said. Alistair, in your desk at Gold Money, have you noticed anything in terms of Europeans flowing more into Gold Money and some kind of indication that there is, in fact, a European fear trade here? I mean, you got the sovereign issue with Greece and the euro declining and people looking around considering that deflation is seriously biting and that it's a risk factor with the ECB kind of, sending out smoke signals that they're going to get aggressive with QE. So what's going on in Europe and money over there? Do you see anything different now that you see maybe versus 2 months ago?
Well, I think the first thing I should say is that we haven't really seen much of a pickup of interest in Gold Money. I mean, I think the typical Gold Money customer is someone who has bought some gold. He looks on it as an insurance against everything else falling apart, and he probably forgets about it. It just sits there as and when he's going to need it at some stage in the future. So we're not talking about active traders. I mean, having said that, we don't see sellers, that's for sure. And silver, when silver dips, people basically buy it. They're net buyers, not aggressively, but gently. They tend to accumulate it. As far as the European scene is concerned, so far I don't think there is an awful lot of movement into gold. I think what has happened is that Europeans who are worried about the euro have tended to move into the dollar. However, I think it's only a matter of time, and probably not a lot of time, before they begin to think of diversifying from the dollar as well. But that is, I think, going to be dictated by events in America and how the Fed responds to them. Interestingly, I would expect to see some demand building in Japan, and I don't know whether any of the other panelists have seen that. That, to me, there is currency destruction happening, and it's happening before our eyes. And the fact that economists seem to think that all this quantitative easing is going to lead to a recovery in the Japanese economy next year, I mean, they missed the point completely. Basically, the Japanese are destroying their currency, and I would expect to see quite a lot of Japanese money moving into gold. But that's against a background, as I think we all understand, that there is very little physical bullion around. The demand from China and Indian demand has picked up again because the Indians are now permitting gold to flow into the country a lot more freely. Russians are buying gold, certainly the central bank is, and I should think the oligarchs are buying it to a degree as well. There isn't a lot left over. So I think when the Europeans wake up to the thought that perhaps they ought to have some gold, it will probably be back on a price that is already rising, and they get the feeling that they're missing the boat. And I suspect that's going to be the characteristic of the gold market in 2015.
We have seen periods where the Japanese granny buyer, so to speak, comes in really aggressively, and then all of a sudden everybody's just kind of taken aback by that. I believe it was like in 2010, if memory serves, when there was a huge burst of just for whatever reason the Japanese decided to buy. So, yeah. David, what do you see as far as what's going on in current dynamics?
Well, I really can't add to what my two predecessors have said. I think Alistair did an excellent job of giving out factual information. I mean, I'll just add or repeat, really. I mean, the idea that you can print your way out of this doesn't work. There's some extreme examples in history, but, Argentina, Zimbabwe, there's several. And so for Japan, a leader at one time to go on this Abenomics is insanity. And there's a price to pay.
I'm kind of operating on the theory that certain conditions in our precious metal space now are a lot different vis-a-vis this whole inflation, deflation question of the end game. And, we've gone through 18 months of just incredibly aggressive drawdown of inventories from bulk supply in gold and silver, and the nature of freely available physical supply is completely different now than when, say, QE2 was launched in 2010 through late 2011. We had really tight correlation with the QE and where gold was rising as one would expect. And then all of a sudden, since 2011, we've had a stepped-up level of price management and manipulation that's been dogging the industry for years, culminating aggressively in what we have seen with available physical supply dwindling and GOFO sending negative signals more aggressively and frequently lately. And all of that as background and context, I think, suggests that a number of things that may happen this time going forward if we are to have deflationary credit system problems creating turmoil that could conceivably make people want to buy precious metals. In 2009 and in the period after the 2008-2009 crash, it took a long time, say about 9 months roughly, for people to come back to the precious metal space because there was so much rush to liquidate in order to meet the lack of sound collateral in the banking system, in the shadow banking system. And this time around, because there's far less physical available to serve that role, I think we're actually looking at a scenario that could be very different in the way things play out this time around, even with silver not necessarily getting a bad rap when it comes to its questionable performance in times of deflation. I mean, there are a lot of people in our industry who are saying even gold is going to go down to 700 or whatever per ounce if we do have a deflationary crash. So with all of that as background, setting the table for discussion about what could be some of the higher probability outcomes in this year ahead and beyond, I'd love to just toss it out there and see what you guys think about those ideas.
Well, sorry, if I can kick it off. One of the things
Sure.
which I think is important is that people do not know how to value gold. And, the result is that they accept that today's price is the right price. It is the value of gold. Now, I mean, from an accounting point of view, of course, it's correct. But actually, if you consider this properly, then gold should at least reflect in its price the excess production of paper money, fiat currency, that has occurred particularly since the Lehman crisis. And if you adjust the price of gold for that, we end up with a price not of $1,200, $1,220 or whatever we are at the moment, but we actually end up with a price of $490 in Lehman, pre-Lehman dollars, if you like. So if you deflate all those dollars that have been produced since, the price is $490. Now, we're sitting here seeing this really wildly undervalued asset, which has not increased, while every other asset has basically increased. So you can see that the markets have got tipped very much in a direction, if you like, that suits the investment community, because let's face it, hedge funds and all the rest of it are not interested in gold. They're interested in having bonds go up. They're interested in derivatives continuing to trade. They're interested in equities going up. That has been the story. They've got wildly overvalued. I mean, just look at the situation with Spain. 10-year bond yielding less than 2%. Would you lend money to Spain at less than 2%? I wouldn't. I think it's completely mispriced. I'm not saying it's going to change immediately, or I'm not going to give a timescale for any change in prices. But we do know that the normal investment media are wildly mispriced. That's where the mispricing is. And gold has been neglected. And at some stage, that is going to switch. And I think 2015 is the year it's going to switch. So the big point that is worth making about the price of gold is that the price of gold is actually not a true reflection of its value.
Well, I'd like to second what Alistair said in that, if gold had kept up with the inflation in the U.S., it was commonly talked about years ago, it would be $2,400, so say $2,600 now or something like that. It's ridiculously underpriced on that alone. I mean, if you look at it that way. And then silver is what kind of market is trading at 1/3 of what its high was 34, 35 years ago, and even as much as 3.5 years ago. And down from 50 for whatever the reasons were. The fact is it's there, and for where we come from in terms of this gold cartel stuff. But I've never seen a more heavily traded market and sat on market than silver, as we've seen since last March, with just a few exceptions. And it's been unbelievable. And from our standpoint, we think it's because they're scared to death that if they lose control of silver, it's going to affect gold in a big way. And it's just ridiculously priced. And when this comes in, and when you have all these other assets that have been so high, and you've got gold, it's already artificially down there. In other words, it's collapsed as the other assets have gone up, as Alistair was saying. So there's a good chance as they've gone through all this extra gold and silver to get the job done down here, to create certain perceptions, that the volatility this year finally on the upside could be something that we haven't seen in the whole move up. In other words, it won't be. We've had some really big days over the years, but it could be really spectacular and sustained.
Yeah, can I step in again? I agree with that, Bill. I think one of the things that we've got to assess is what is the economic outlook for the world. Now, I think that the fall in the price of oil, and also this is reflected in iron ore as well, which has also fallen. It's roughly lost about half its price over the last 6 months, just like oil has. What that is telling me is not that you've got loads of shale oil and all the rest of it, and it's oversupply of oil. In fact, the figures actually suggest otherwise. What it's telling me is that the demand, for some reason, has collapsed. And this demand, the collapse of the demand, has something to do with the emerging markets. It's the emerging markets that have had to put up interest rates in order to protect themselves against the dollar. So we have a situation where roughly 30 trillion of the global GDP, which is emerging markets and developing economies, is basically going down the tubes, and the advanced economies account for about 47 trillion of global GDP. So you can see that 30 trillion actually is going to upset the other 47. It's bound to. And so the proposition I'm putting forward is that there is quite a large part of the world that is going into a slump. That's what the price of oil has to fall to a level where people are prepared to buy it again. And we're not there yet. Now, when you get a slump, basically it's the unwinding of malinvestments under what's referred to as Austrian business cycle theory. And we've only just started that. Businesses around the world haven't unwound those malinvestments yet. They're hanging on to their investment programs in the hope that things will improve. They will discover in the next month or two, if I'm right, that things are not going to improve. And then when business around the world starts cutting its investment programs, abandoning investment programs, then you will see that we are definitely in a slump. And the two economies of the advanced nations, which are really in the firing line on this, and really because they're predominantly weak, is Japan, which we've already touched on, who are destroying their currency, and also the Eurozone, where, the problems, we all know the problems there, there's no point in going through them again. That accounts for another 18 to 19 trillion of GDP. We're now left with the UK and the US. Now, the UK is a trading nation. We depend very much on trade with the European Union, with the Eurozone. So, consequently, the UK is at risk, and that's quite a lot of risk. We're about 6% of global GDP, I guess. America, which is about 21% of global GDP, is better insulated because you've got a far larger internal economy. But nobody can persuade me that with the rest of the world going to hell in a handcart, that the US can just continue on as normal. No. I think the whole thing is going into a slump. Now, that being the case, this is, you call it deflation if you like. Now, deflation is actually a bad word because it doesn't actually describe what goes on. But basically, what happens is that the strains then come back onto the currency. And the reason for this is that the automatic response by the central banks is to step up the issuance of currency. I really do think that Mr. Draghi in the Eurozone is going to be the second producer of Abenomics, if you like, call it Dragonomics. He's literally, they're one step behind Japan. They've got exactly the same problem. And the underlying problem, apart from the business cycle theory, is the fact that we have got retirees who aren't paying any taxes at all and probably drawing on the state, increasing in number, while the young who are earning are either not employed or the numbers are not increasing enough in order to pay the taxes to support the retirees. It is a particularly acute problem in Japan, but also around Europe. We have such generous welfare programs. They are completely unaffordable, and no politician is prepared to tackle it. So we've got the seeds of our own destruction in the long term, and at some stage, I think this year, as we go into a slump, the assessment is going to be amongst investors, this actually is a very, very dangerous situation. And inevitably, the conclusion of this is that currencies, paper currencies, are on the way to collapse. Now, I'm not going to put a timescale on it, but I cannot see how that process can be reversed. So the idea, I think we've got to put this deflation-inflation debate into perspective. We're going to have a slump. That basically means that people are not prepared to pay current prices for raw materials and goods and services. Prices have to fall. The response from the central banks will guarantee that the purchasing power of the currencies will fall soon after. And it is the function of a market like the gold market to anticipate that happening. So in that sense, I think the gold market is going to be a bellwether in terms of seeing how this progresses through the advanced economies. So we are, if you like, I feel rather like, I don't know, sort of a butcher in an abattoir, sort of watching the death of everybody with interest. It is not a nice thing that I'm talking about, and I just wish I could see a way out of it. But I think this year is going to be very, very difficult. And, that's why I'm very keen that anyone who has an inkling of understanding of the importance of sound money actually does protect themselves with a bit of gold and silver.
Yeah.
And, physical.
So, guys, if we run with Alistair's analysis on this in the slump, and David, I'll hand this question off to you first. I think a lot of our listeners would like all three of your thoughts as to what will happen this time with not only gold and silver bullion, but also the shares. No doubt everyone remembers the slaughter that happened in 2008, the last big downturn when the mining shares were just annihilated. But we really have already seen that over the past couple of years in the shares. A lot of the valuations are at levels that were seen back in 2008, and this is with gold at around 1,200 versus, I think gold briefly broke below 700 back in 2008 at the low. Just to toot Eric's horn a little bit here, privately a couple of weeks ago, he was recommending a couple of different ETFs. One of them's up about 70% since then. The GDX has broken out. So I'll let you take this one first, David. Are the mining shares going to decouple, as we're seeing early signs of here in January, if we do see a big slump in 2015, or do we still have to be cautious of the shares as well as the metals?
Well, there's risk in everything, but we did an analysis on our portfolio, and we picked our, lowest or best valuation stocks. In other words, stocks that you could buy at 30 cents on the dollar. And some of those are already up 40% in the last 2 weeks. They're not as strong as a leverage ETF, but it's very, very strong. Looking at the bigger picture, I'm going to work in on the questions because you sent them to us by email before the interview. And so I'm going to answer that, and then I'm going to move on further to what you just asked me. But one of your participants asked about, what is the level of silver in the world? Is it 1 billion ounces? And the answer is it's really 2 billion ounces. There's 1 billion roughly in coin form, which is countable coin form, which means silver eagles, silver maples, comes out of the Perth Mint, what comes out of the Eurozone with government mint marks on them. So there's 1 billion in coin only. And then there's another 1 billion in what's called commercial bar form, or what's traded on on the exchanges, be it LBMA or the COMEX. So there's roughly 2 billion ounces in physical metal. Now, as far as what will happen with the mining shares of the metals going forward is, again, it's really tough to put a time frame on it. But what we do know is from the last experience from the 70s up to the peak, January 21st, 1980, was a huge acceleration in the move. And that was really a U.S. phenomena only. Basically, in those days, we called the bond vigilantes were looking at what the M1 money supply was, and those figures came out, I think it was every other Friday. And based on what the money supply increase was, you would get a huge surge into the gold and silver markets. And that took place up until the time that Paul Volcker took over as the Fed chairman and, of course, moved interest rates up to what I call loan shark levels, quelled the market, and we had a 20-year bear market of metals. If you fast forward to this bull market, what took place in the early 2010-ish range was that when QE2 was announced, silver had already broken out of the $19 level, and I actually put a trade on, and we do more than trade. I invest, but I also am pretty good at trading the markets on a longer-term basis, position trading it's referred to. And I saw the breakout at 19 and got on board, and it moved rapidly up to about the $26 level. And that was as high as it had ever been up to that point in time from this bull market. Now, remember, I'm talking about a few years ago. And then at the $26 level, QE2 was announced. Now, based on past history, that was similar to what had taken place in the 70s, where the bond vigilantes were looking at what the Fed was doing, and if they were increasing the money supply, it directly correlated into an almost instantaneous increase in the paper price of gold and silver. And that's what the market anticipated. So once QE2 was announced, we saw this huge surge from 26 up to 48 and change in the silver market. But what took place was all of that printing, which is validly and verifiably, factually there for everyone to see, was it didn't go into what we call or could call price inflation into goods and services, into the wages of people, and that kind of thing that you did see in the 70s. And the market really got punished for that. And what happened was we, from that point till now, have really had a bear market within a secular bull market. We've had a bear cycle within a bull market, let me rephrase that. So now we have all kinds of discouraged people. And I said all of that to say this. The amount of metal that's available physically in the world versus 1980 is probably roughly the same right now, except that we have a global participation potential and obviously taking place. Look at what the imports are, even for silver into India. China, it's hard to get a good number on. Look at the amount of silver eagles, silver maples, etc. So the retail side is very strong. The wholesale commercial bar side seems to be relatively strong. And certainly the economic conditions of the world are probably a factor of 10 times worse than they were in the 70s. We know that the money supply, if we believe the government figure, is up about sixfold. So if you go to the price of gold and silver back in January 21st, 1980 at the highs, look at roughly $800 gold and multiply by 6, you're looking at $4,800, assuming, a constant dollar. I mean, this is, shows you the amount of inflation that's taken place, but it hasn't come into the general economy. And that's what people are waiting for or expected to see, and it didn't happen. So the answer is, I believe you could see a shortage or a situation where it is difficult to impossible to buy the metals physically in size. So you could be in a situation where you might be able to buy on the retail level, small amount, 100-ounce bars, 200, a few thousand ounces, that type of thing. But for an Eric Sprott to come in and buy, 20 million ounces of silver, 3 weeks in a row, I believe that might be an impossibility in the future. And if that's the case, then people are going to go to the mining shares like it's never, ever happened before. There's two reasons for that. One is that if the tightness in the physical supply or the premiums become so great for physical metal, people will go to the next best thing. And the second one, and excuse my position, but I'm going to state it as I see it, and that is a lot of people are lazy. So most people have a E-Trade, Ameritrade, Scottrade. I want to leave them one out. I don't get paid by any of these people. that they have some kind of stock trading account. It's very easy for them with the mouse click to find XYZ mining. And so any gold mining company, silver mining company that has gold or silver in its name will be a proxy for owning the metal, because people will rush to anything gold and silver as the manic panic buying phase takes place. Now, the only thing I can't tell you is when that's going to happen. I mean, I'm on record as saying that probably expected around 2016. So we've got the whole year 2015 to kind of wade through where we're going to go and how we're going to get there. But as Alistair said, and I want to back him up totally, and it's just not him, it's a lot of us think the same way, is, it could happen day after tomorrow. I mean, there are so many anomalies out there and potentialities with what's going on with the insaneness of the financial markets and the insaneness of what the money supply figures are relative to what the gold and silver amounts are, that something could light a match to a gasoline warehouse literally overnight. Now, I'm not forecasting that, but it's my duty to explain that it could ignite very, very quickly, and that's why you want to have a position ahead of time. You don't want to be 6 minutes late. It's much better to be 6 months, 6 years too early. And if you look from a longer-term perspective, in this bull market, it's been over a decade long. I mean, it's only been the last few years that gold looks like, you shouldn't have been in that market. But if you go from 2000 and you look at it from a longer-term perspective, many people that bought 2000, 2001, 2, 3, 4, 5, 6, 7, 8, I mean, they're really not that unhappy with their gold position. They might wish it goes up every year, but that's wishful thinking. No investment goes to the moon directly. There's ups and downs in any market. So I'm done. I think the shares are going to do quite well. And in a bull market, you see the shares actually leading the bullion. Now, we're getting a bounce here because of tax loss selling, and a lot of people are bargain hunting. A lot of people know how to play the January trade. I've done it myself many, many times. It could just be that, or it could be something that's signaling to us in a subtle way that things are actually improving ahead of time, and that would be that the shares are, gaining in price while gold and silver basically are flat to sideways. That would be a good clue that things are going to improve.
Leave it to
I think we actually saw that back in late October in what I termed as a stealth capitulation. Because if you look at the volume on anything like GDX or whatever, I mean, you literally can look anywhere, and you see that we have 3-4 months of volume running in, on average, about 80% excess of what it was in the same time frame of 2013. This kind of gigantic rotation underneath the carpet and a process of give up, of just not in its major spike down style capitulation that people would notice immediately and say, oh, there it is, there's the bottom, but in fact this kind of like grinding pain associated with the unusual characteristics of the current bull market or the bear market, cycle that we're arguing is happening within a context of a longer-term bull market, precisely because of the kind of manipulation by the powers that be that are freaking out about trying to keep everything under wraps and under control. And, we've never seen a 4-year period where mining shares go into the tank. I mean, this is highly unusual. It's this long stretch of unbelievable pain, bleeding in the sector, and I think that is actually setting up for a pretty interesting 2015 going forward. I'd love to.
If I may add here, it's Bill here. That for the most part, it was unbelievable to me that gold and silver have been different since when we first started. The shares went back to zero. It was an absolute waste of time, outside of some really good exceptions, to invest in these stocks for 15 years. I mean, I hate to say it, but that's the way it's been. The shares are at the same price or lower. Just the other day, what was Barrick at, 9, 10, 11, 10? I think it was started when it was 15 or something. I mean, I know Barrick's a different example, but there's so many of them that it's been a horror show beyond comprehension. And I couldn't have imagined this way back when. Now, that said, I think I go back to Newton's law. And about an equal and opposite reaction. I think we're going to get the most historic move of any market in history as this kicks in. It's going to absolutely stun people, and it's going to do it. But what I think is going to happen, as other things go and are having trouble, the shares, because of what my colleagues have talked about, the diminished supply and what's happening, and when it all hits the wall, there is going to come a point, even if it's brief, where there'll be no offer. And they're right. And it's just because you'll have the problems in the unallocated accounts, you'll have a force majeure someplace. Everyone, all at once, everyone's going to be concerned about getting their gold in hand and not have someone else holding it and find out it's not there. Once that starts, it'll feed on itself. And the move into these shares as the price goes up, because the companies down the road are going to be so profitable and be such home runs, it's going to be a sight to behold. So, but facts are facts. Over the past, all these years, it's just been awful. And I think it's all going to come back and go full circle, and more so as we go into the years ahead. And I think it's a very exciting outlook that we have, and as bad as things have been for a long time.
I know you got to jump pretty soon, Bill, but I wanted to ask you this, and then Alistair and David, please chime in. One of our listeners was really curious about what's going on with J.P. Morgan, and Bill, you talked about this a lot in terms of what J.P. Morgan may be doing with their silver inventories and all of the questions that come about that. And one of the particular questions he asked was really interesting. He says, could you explain how it was possible last year for J.P. Morgan and the like to get away without settling on derivatives for months? And he parenthetically notes that was evidenced by the lack of movement in the dealer inventories. And to what extent do you think that comment is on target? And what do you think as far as what J.P. Morgan may be doing in relation to their COMEX positions and maybe even OTC? David, we talked about this on a previous show together too, and just all the fog that surrounds this question as to what J.P. Morgan and more broadly speaking, the bullion banks are doing in general. I'd love to get your feedback about that.
David's the man in silver, but when it comes to J.P. Morgan, I don't know why people don't want to talk about this again in the mainstream world. I mean, what they've been fined over the past years, $28 billion, and been found doing wrongdoing, or been fined in every market you can think of, whether it's LIBOR, whether it's energy, whether it's mortgage rates. I mean, every market you can think of in currencies. I mean, they get fined and fined and fined, and yet the only market that they've never done anything wrong in which they've been accused is silver. The only one out of all the markets. And from Gada's standpoint, I'll speak for myself here, obviously, is that it's because the government's involved. J.P. Morgan's the Fed's bank, and when it gets down to the nitty-gritty in that thing, this is one subject that cannot be discussed or talked about or regulated. There's no cop. There's no sheriff. The CFTC is a joke. So, I mean, I can leave it at that they're still there. And that's why I think when they hit the wall, and I'd love if David knows when they think that might be, because I know as he's speaking to John Embry and Eric, we can't figure out where the silver's coming from. But they must have gone through all kinds of silver to do what they've done. And when we finally go, the move silver, the big move is coming and the fastest move.
What do you think about the rumors of J.P. Morgan offering cash settlement premiums for people rather than people taking delivery? Have you ever seen any substantiation of that, Bill, David, anybody?
I haven't. I mean, all I know is that if whatever they're doing, it's to assist the gold operation and the whole thing. The silver's their Achilles heel. They're afraid if they lose control of that, the thing could take off and go bonkers. And so they're just all over it. And they say when it blows, it's going to be something to behold.
Yes, on silver, I have a theory which I'd be interested in David's view as to whether I'm talking complete rubbish, which I may well be. But I think that J.P. Morgan not only deals in the market. I mean, that's on the COMEX market. That's the only visible side we see. But I think they also work with companies like Trafigura and Glencore, who go to the silver mines in the middle of the jungle and take the silver doré, ship it for processing, most probably in China, which is the cheapest place to do it. Meanwhile, because that process takes a bit of time, and the silver mine always has cash flow priorities, J.P. Morgan lends them the money. And J.P. Morgan basically gets the silver. So I think I think that they've got quite a lot of production from odd mines all around the globe tied up on the back of this sort of commodity financing business. I don't know. Am I wide of the mark, do you think, there, David?
Yeah, you're right on. I mean, this is why the Silver Users Association was put together years ago, because 70% of the market comes from your, $600 billion market cap companies like RTZ and BHP, and they produce roughly 70% of the silver. And if you look at the silver, what their silver output is, it's huge. But if you look at what the silver price proportion is relative to other mining activities, it's almost a rounding error. So what has happened, and it's been going on for a long time, is exactly what Alistair just explained, that these miners have a middleman, which is a bank, which has not only facilitated going from the smelter to the user, i.e. the Silver Users Association, making that process of, you might say, good old boys put together so that the miners have good friends on the other side, and then with some friendly banker in between. But they also get the book. The book means that they know what RTZ is doing on a monthly, quarterly, semi-annually, and annual basis, rough numbers. They also know what side is, buying. They also take that knowledge and run it into the futures markets, both at the LBMA and in the COMEX. And so they also can do OTC derivatives, which is far greater than what you see in the transparent markets, which are available to the public to be able to determine, what the price, the volume, et cetera, are. So it's a hugely contrived market. I don't know of any other market, even the oil market, that have OPEC, and they can set the price, being the marginal producer like OPEC. I don't want to drift off. I'm trying to give a solid idea here, but I mean, there isn't any other users association on any other commodity. And as Bill said, every J.P. Morgan, like it or not, has come clean at the end of a gun, as a metaphor. Someone's pointed out the fact that they've manipulated market after market after market, but oh no, we've never found anything wrong with the silver market. So the point is that not only do you have 70% of the market that's controlled and has been forever almost, you also have the derivatives markets that are controlled by the same people. And the last thing I think is extremely important, based on the email that you sent me before the talk here, is how few people really understand how these derivatives markets work. I mean, I don't know how many articles are out there. I don't have time to count them, but I know because I read a lot. I don't look at the chat rooms anymore. I haven't in years. About to say I would see one now and then someone sends me directly. But there's a gross misunderstanding of the physical demand versus derivatives. Basically, this is going to be an exaggeration, but an extremely slight one. For almost all practical purposes, no derivative is ever required to be settled in physical. Now, I exaggerated slightly, but the idea that they have to, someone could stand for delivery and take the metal and bring these guys down and on is incorrect. It cannot be done. The exchange has set this thing up so much in favor of the shorts and the paper players that anyone that thinks that they can go into the COMEX and take these markets down doesn't read the contract. I mean, I have written and talked, but, there's always someone that doesn't get it because there's so much information about it that's inaccurate, it's untruthful. It's misleading, and I don't think it's deliberate. I think someone reads somebody's article, and then they write based on that article, and then someone reads that one and writes based on that one. But the CFTC itself came out here to Spokane years ago at the behest of Phil Baker, the new CEO of Hecla, when he took over from Brown, and I knew Art Brown for years, and I live in the area, and I was there, and the CFTC made a lot of different points. One was that they never changed the rules on the hunts. Now, I'm not saying that's a true statement, but he said it in front of everybody, and I don't have the contract available for me to read to check, but I have got one that's current now, and they can make anybody at any time settle for fiat. So,
Right.
and even if you stand for delivery, your standing for deliveries amount is set at a certain limit. It's 1,500 contracts, 7.5 million ounces. That's it. So if you have $12 billion cash to take down the COMEX, it wouldn't do you any good. They would say, well, that's nice. Here's your paper profit, and here's your 1,500 contracts delivered to your door. Where do you want the 7.5 million ounces to show up? So this is a rigged game. Go ahead.
What's interesting about that, though, Dave, is that I think that it's slowly, and this process is almost glacial in its speed, dawning upon people in the financial community that is, in fact, the lay of the land, and that if the quote-unquote brown matter hits the fan, that there's not going to be the physical out there for people to have true, honest hedges against the fiat Exeter pyramid that's grown to the stars. I mean, it's just insane what's going on now. And one of the interesting things, too, I was thinking back about what we were talking about before, the difference with, the North American market being the primary driver in the last mega bull market in precious metals in the 70s and 80s. Back then, we did not have the issue of the interlinkages to the degree to which the shadow banking system has now, with the derivative contract daisy chain phenomenon that can go off now versus what it was like then. I mean, sure, it existed to some extent then, but now, I mean, God, we're well over a quadrillion notional value in the derivatives market, and everyone else is doing their laundry. Everyone else is doing everyone else's laundry. I mean, the discussion you had with Greg Hunter about the prime analogy with the real estate crash and how you can draw analogies to the oil crash, putting in peril at least $170 billion worth of junk credit that's financed the oil shale and other oil endeavors in the United States market is very much apropos. We don't have time to dive into that, and we're going long now as is anyway, but I highly recommend everybody to check out that interview that Greg Hunter did with David Morgan. It was a fantastic interview. We'll put a link in this show's write-up. But anyway, it's very different qualitative conditions that exist now versus even in the last bull market.
Very much. I mean, I'm ready to hand it off to somebody. I mean, I've said my piece, and there's still people that'll read and not understand, and it's not that difficult to understand. But just realize that the futures market is a price determining mechanism, and through the paper manipulations, you can basically set the price almost anywhere you want. And the one thing I have to be fair about is that the quote-unquote shortage really hasn't shown up yet. Not that we didn't have one in 2008 at the bottom. We certainly had a shortage of silver retail product, but not silver commercial bar product. But that certainly could happen. And so price isn't really a good determiner of how much available silver there is. In fact, I would maintain that right now both these markets are far tighter than the price alone would lead you to believe. And that's why, as Bill said and I said earlier, the shares probably stand to move for several reasons, one of them being that there could be a situation where there's enough physical demand, or there's people that think they own physical, that all of a sudden they get spooked and say, well, let me see it, or I want it, or delivered, or that type of thing, and there's these delays in the markets or this big logjam. And there's a real problem. And then when people have fear, fear is a bigger motivator than greed. They'll start to really panic, and they'll start doing whatever they can to not only buy physical metal, but also to go to the proxy. So I really think we're in uncharted waters. The amount of demand that's out there, there's an infinite demand for money. And when you think about money, what it represents, and it represents a lot of things to a lot of people, but it boils down for most people, security. You want to save something now so that you have some security in the future that you can buy the basics, food, water, shelter, or some gizmo. But the point is you're willing to save some value now for something secure in the future. And when you have no security, because that quote-unquote money that you hold, that piece of paper, is losing value, or you have some security that's a piece of paper that says you own some gold, and now you question that, think of what that would do to the psychology, the psyche, if you will, of the entire financial system. And friends, that's where we are. But, you sound like you're some sort of almost a wacko when you make these kind of statements like I've made for so long, but it doesn't erase the fact that it's true. I'd love to hear, Alistair's take on my comment, because, it's like frustrating. You sit there and know what the facts are, and you speak, from the head and the heart, and yet you get this glazed over look because the market's been soft for 3 years.
Yeah, it's a sort of, it's an exercise, as it always is, I guess, in psychology. But we're looking at a multi-dimensional game. When you look at how people attack investment as a whole, they attack it as Keynesian and monetarist economists. They believe in something called macroeconomics, which is a complete sham. If you know the real world, you know that actually what they're talking about is actually either completely irrelevant or very, very distorted. And it's the old cliche, the emperor without his clothes. At some stage, someone is going to shout loudly enough, probably in a very juvenile voice, and say, "Hey, that man hasn't got any clothes," and then suddenly everybody will wake up to it. I mean, it is, but until that moment, these markets are completely mispriced. And you can even think that, if we're all playing equity markets, bond markets, derivatives, and so on, for someone to stand up and say, "Hey, gold is what you really should be trading in," we're spoiling the party. Nobody likes it. They rather continue to deal in the things they believe they understand from a Keynesian point of view, rather than actually take the trouble to understand sound money. And when I sort of get economists commenting on this, on the current situation, they're contradicting themselves the whole time. I mean, the most recent example is oil prices. Falling oil prices is good for the consumer because it will release money for him to spend on other things. Okay, that's one statement. The other statement they say is that falling prices is very bad because it gets the consumer deferring his purchases, which will drive the economy into recession. Come on, you can't have it both ways, for God's sake. But this is the quality of the thinking that we're having to deal with. And this thinking is from people right at the top, not the obvious people who are sort of so sold on Keynes like Krugman, but throughout the whole system. People actually have not got a grasp of what is going on. And sooner or later they will wake up. But so I think the point I'd like to make is that distortion isn't only in the gold market, the distortion is everywhere. And on top of that, of course, the central banks are now trying to manage markets. They're micromanaging markets because they think that if equities go down, we will lose that confidence, if you like, to go out and spend. They need to keep the animal spirits going. I mean, it's a load of absolute hogwash, but they have got an awful lot of money which they can print at will in order to support markets. And that's basically why all asset markets other than gold have performed so well and why gold has been neglected. Now, the central banks can't control this situation forever. It will break down. I think anyone who forecasts, as David correctly said earlier, in my opinion, anyone who stands there and says that it's going to happen on a certain date or it's going to happen in a certain month actually misses the point entirely. We're in a dangerous situation. It can happen at any time. But never, ever underestimate the ability of the authorities to put off the inevitable. And I think this is going to, the situation is probably going to come to a crunch soon, because I believe that the world is moving into a slump, and that is key.
Yeah. I'd like to echo as well what you just said about standing and marking time and doing forecasts for targeting sake and all of that stuff. I mean, there's a huge amount of backlash that's going on now in our precious metals industry, with people reacting to those type of calls, and rightly so, being very frustrated about it. It bears import to say that the process that you, as all three of you as analysts in our space, go through when it comes to trying to figure out what is going to possibly come down the pike, looking in terms of different scenarios, trying to assess different probabilities and so forth. It's really more about an exercise of just having an attempt to draw a map about possible outcomes in the future to help make better decisions. And so many calls have been made in this 3+ year long period of pain in our bear market cycle where people are picking bottoms and calling for price targets that are really high and so forth. And I think it's just kind of wearing people out, and there's a lot of anger out there, and it's justified. So, you know, I want to acknowledge that because there's a lot of people that leave comments every time we do a show, and they're pretty pissed off. But that also speaks to what I consider to be another sign that, you know, we're going through the process of having basically gone through a bottom. I mean, you know, like I said before, there's never been a period where we've had 4 straight years of mining shares sucking wind as much as they have in the last 3. So, with all of that said, anyway, I'm kind of curious, Bill, actually. You speak a lot about the cafe indicator, the sentiment indicator of people visiting your website and whatnot. What have you been seeing lately? It's probably as lowest as ever been. I mean, did it pick up in December?
It's been this way for a while. I mean, and that's another reason that for those of us who are bullish, and maybe I'm perennially so, but the point is that there's nobody around, and the general public doesn't own these shares. The interest in the sector has gone away because of what the Dow and other markets have done. It's been too many years of really not much happening, and you know, people are going elsewhere, and of course that's what I think is setting up something spectacular. And my guess is, and I think most important point I can make is that it's going to come out of nowhere, and it's going to be incredibly volatile to the upside when it starts to go, and it's going to be very exciting. But as you're all saying, to pick an exact time is the kiss. If I did that today, it'd be the kiss of death. It's the way it is. So, but I think we're getting ready for something. Something really good, as I said, and part of it's because of what you just brought up about how there's just nobody home.
Yeah.
Mm.
All right, well, I think we'll wrap up the discussion here, guys. We've had really an insightful discussion here of not only 2015 but beyond, and leave it to David, guys, to make me feel like I don't own enough silver. That's hard to do, David.
Yeah, I guess so. Okay.
But I want to thank you all for joining us today. Really has been a pleasure. Again, David Morgan of SilverInvestor.com, Bill Muprhy of GATA, and Alistair McLeod, Head of Research at Gold Money. Guys, thanks so much for joining us today.
And before you guys sign off, I know that there's some pretty interesting conferences coming up, and I wanted to toss that both your way, Bill, because I believe you'll probably be up in Cambridge House and in Vancouver, right? And then David, you've got a pretty interesting going on. Was it January 22nd, if I remember correctly, the Checkerboard Conference? So you want to tell our listeners about that? I mean, I can mention it in the write-up, but there are some people actually just listen to the show audio-wise and won't see the write-up. So tell us about what's going on. I think people will find it interesting.
Yeah, well, I'll be in Vancouver with Bill on the 18th and the 19th of December, and then the next weekend on the 24th. Back to Spokane, and there will be a conference here. It's called the Checkerboard Game. It's Marshall Thurber, Daryl Schoon, and myself. It's really about change in the global economy, how the monetary system plays into that, and basically what you can do about it. So it's basically a big picture analysis, kind of top down, to get people really familiar with the global picture and the kind of problems that we're facing and what they as individuals can do about it. So you can look it up on my website. If you're really interested, I suggest that you look at the TED Talk that Marshall Thurber, Marshall, Thurber, Thurber on TED Talks. That'll give you a good idea of what the essential parts of this lecture will be. The second half of the day will focus more on ground level, gold and silver investing, that type of thing. But the first half will be more directed toward global thinking.
It sounds like an interesting program. I might even head up there myself. I'm down in Medford, Oregon, so Spokane isn't too far away from me. So maybe you'll see me show up if I can free up the time in my ridiculously busy schedule. So, but anyway, thank you very much, gentlemen. It's been a pleasure speaking with you.
Thanks, guys, and thanks to all the listeners for tuning in to the special edition of the SD Weekly Metals and Markets.
those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They used the word orderly. As long as it's orderly, it seems to be okay.